Okay, so as promised, this is the second video of the two-part series discussing about the entire situation surrounding Ant Group, and specifically, what are the implications of this entire credit scoring system problem, and more importantly, how is the entire industry getting affected by all these different regulations and clampdown. And last but not least, I will also be sharing about my entire investment thesis on whether is it affected and whether has it changed over the last few days or so. I think I just really wanted to draw your attention to this tweet by one of the fan favorite and all-time favorite of this entire channel, which is by Rui Ma. I think she really succinctly put the entire backdrop of the situation and really ground us in the context of Ant Financials and why Chairman C, or regulators in this case, are quite jittery about the entire developments of Ant's role in the financial system. So let's see. She said, basically, imagine if the dominant payment processor also scored your credit. So a dominant payment processor, giving you an example, would probably be like Visa or Master. So assuming that Visa or Master also has their own internal credit scoring system based on your payments through them. And in this case, they really take into account all your transaction patterns, your consumer patterns, and so on and so forth. So in this case, on top of just helping you process and facilitate your payments, they also gave you loans based on your score and the history. And they essentially own the entire process. So think about like Visa and Master now also running a fintech arm, allowing them to disburse loans to all these different customers that are on the Visa or MasterCard payment platform. Oh, and don't forget that it was tied to the largest e-commerce platform too, with around 60% market share, which in this case, which is Alibaba's e-commerce market share. So if you're asking why was this allowed, it was a combination of many things, including immature regulatory oversights or gaps, a growth at all costs mentality, and the speed at which it happened. And let's not ignore the fact that it did make consumers' life easier in many ways. So I would also like to clarify my position. And of course, there's been a lot of problems plaguing the entire Alibaba's business. Firstly, in the entire e-commerce arm, where they talk about the 2-choose-1 business model. In the long run, I don't think it's really a sustainable business model because you don't get to win your competitors by excluding them out into your system. I think you get to win them by providing better value proposition in terms of convenience, in terms of product superiority, in terms of user experience, etc., etc. There are a huge ton of metrics and benchmarks out there to help quantify and to help us as investors to understand whether is that a much better product or are they offering a much better service. And in this case about Ant Financials, they are also essentially tapping onto their own internal credit scoring system. So of course, in the long run, it's not really a very good thing for China's economy and China's financial system, because ultimately, I think a lot of the mature economies and mature systems out there do have their own centralized system. But in China's perspective, and during the last 5 to 10 years of growth, Alipay was really in the right time and the right place, allowing them to exploit the entire situation. So in this case, you can really look at it as the government stepping in to try to patch up all these different loopholes in the system to ensure that different companies cannot exploit them anymore. In the long run, I think if you are betting on China, I think it's an extremely sensible way to try to build the foundations of the financial system. But of course, in the short run, all these different companies that manage to exploit these different loopholes will suffer an immeasurable amount. So let's take a look into what are all these different commotions surrounding this entire credit scoring system that they wish to nationalize data, and how would it affect Ant Financials. Now, there was two Reuters articles that discussed extensively about this entire credit scoring data, and let's take a look at what they've been talking about. So in this exclusive release, Chinese regulators to push tech giants to share consumer credit data. So China plans to push tech giants including Ant Group, Tencent and JD.com to share consumer loan data to prevent excess borrowing and fraud. So large internet platforms have tended to resist handing over their data, a crucial asset that helps them run operations, manage risks, and lure new customers. So the Chinese regulators plan to instruct the internet platforms to feed their vast loan data to some of the nationwide credit agencies. So they are also run or backed by the People Bank of China, will share the data more widely with banks and other lenders to adequately evaluate risk and to prevent over-borrowing. So smaller banks are generally in a weaker position when they partner with fintech giants like Ant. They have heavily relied on Ant's data to underwrite loans and manage risks. When default happens, they have to shoulder most of the losses. and it's crucial for lenders to have a better access to more comprehensive and detailed data on borrowers. So I think the biggest problem here is really the information asymmetry. On one hand, all these different fintech companies like Tencent, Alibaba, and even JD hold a disproportionate amount of influence in terms of governing and in terms of running their algorithms and profiling all their customer base. And on the other hand, all these different banks, regardless of whether they are state-owned or not state-owned, they are at the mercy of all these different fintech companies because they do not have access to these different customer profiles, risk profiles, consumer spending patterns, etc., etc. And for those of you who are in developed countries or economies with extremely matured financial systems like in the US, UK, or even in Singapore, we all have a very centralized and a very matured credit scoring system. So from the bank's perspective, they can very easily pull out your credit scoring history by looking at how credible you are in terms of repayments of your loans, what are your current outstanding loans, and what is your capacity in taking on more loans. And these are all deemed as public data. So in terms of coming up with an internal framework to ensure that they are taking on an appropriate amount of risk, but in this case in China, they really lack this centralized governance system. And a lot of all these banks really just are at the mercy of all these different fintech payment platforms. Because they do not have access to the different data, they will just have to take whatever all these different fintech companies like Alipay or WeChat Pay say at face value and just disburse the loans appropriately. But in this case, they are really then at the mercy of all these fintech companies and the algorithms in which how they deem people's creditworthiness. And to make things worse, Alibaba and Ant Group in this case really exploited their position in how they handle and how they have access to all this data. And of course, they do not have to take part in any of the risks. And for those of you who watched the previous video, you know that Ant Financials only took part in around 2% of all the outstanding loan, which also means that the remaining 98% of the loan is borne by all these different banks. And this is really a very lopsided relationship. Ant Financial get to enjoy the upside of referring and allowing all these banks to get access to the different data, and on the other side, they do not have to take on any risk. And essentially, Ant is trying to have the cake and eat it. Now, Ant also runs a Sesame Credit, one of China's biggest private credit rating platforms, with proprietary algorithms and methodology that score people and small businesses based on their use of Ant-like services. The firm offers limited borrower information to about 100 banks, and to take so-called technology service fees, a 30 to 40% cut. So Ant's consumer lending balance stood at 1.7 trillion yuan as of the end of June, accounting to 21% of all the short-term consumer loans issued by Chinese deposit-taking financial institutions. So from the regulator's perspective, they're extremely uncomfortable with the entire situation. Ant is currently exploiting their position in having access to all this different data, while at the same time asking all these big banks to bear all the different risks. So now, the Chinese government intends to nationalize all these different credit scoring ratings and system that Ant is currently using. And let's see what they have to say. So Chinese state firms to take big stake in Ant's credit scoring joint venture. So state-backed firms are set to take a sizable stake in key Ant Group asset for the first time, in a move that will loosen the Chinese fintech giant's grip on a data treasure trove of over 1 billion users, but help revive its IPO. So Ant and Zhejiang's Tourism Investment Group will each own 35% of the venture, while other state-backed partners like Hangzhou Finance and Investment Group and Zhejiang's Electronic Port will each hold slightly more than 5%. So the plan, part of Ant's business revamp, would represent one of the most prominent outcomes of a government push for state-backed firms to exert more control and influence over a fast-growing but previously lightly regulated new economy business. So its attempt to break its monopoly on information and strictly comply with the requirements of credit information business regulation. So the venture puts Ant lucrative micro-lending business under tighter regulatory purview. The proposed joint venture will collect, manage, and analyze consumer data to score people's credit, thereby bringing Ant's main business data operations together and making regulatory oversight easier. So they aim to establish what would be China's third licensed personal credit scoring firm as soon as October. So I think after understanding the entire situation, some investors might be a little bit uncomfortable and a little bit unhappy about how things are playing out in China. I think in this case, if you were to look at it at face value, Ant Financial's product superiority and innovation really managed to address a problem that even the government and regulators do not have the ability to do so. And by looking at it from this perspective, hey, Ant Financial managed to solve a very big problem, which is a credit scoring system. And even the national government or national agencies do not have the ability to do so. And after Ant Financials having the ability to crack the code, now the Chinese regulators and Chinese governments intends to nationalize this entire business and take it for their own control purposes. I have two specific opinions in addressing some of your concerns. Number one, I think the financial services industry, or at least in the financial payment industry, it's a very sensitive problem. I would dare argue that it constitutes national interest, which is also why the regulators and the government has been putting in a huge amount of effort in trying to regulate the entire industry. Because as we all know, not too long ago in the 07-08 crisis, even matured banks, even matured economies can essentially become too complacent and allow things to spiral out of control. So if you are trying to operate in an industry that's highly sensitive and would obviously get a lot of regulatory control, then you should be cognizant and expect this kind of regulatory controls to be put forth onto your different businesses. And on the second point, as an Alibaba shareholder and as an investor in China, I think there's a very important distinction that we have to make. We are essentially betting on China being one of the world's largest economy and how they are able to translate all this into different shareholder wealth. And of course, we will want long-term sustainable shareholder wealth. And if we were to really scrutinize Alibaba's e-commerce business, and in this case Ant Financial's financial business or micro-lending business, there were really multiple attempts in trying to exploit the entire loopholes of the system. And in this case, for those of you who want to earn quick bucks and just want a hit and run overnight fortune, and I would say that investing in China would not be the best investment for you. I would really believe that from the Chinese government's perspective, or at least from the Chinese regulators' perspective, they are really intending to try to structure and orchestrate how the Chinese economy were to run in the next 5, 10, 15 years. They are not here to try to create a speculative bubble and for people to reap all the different profits and run away just after a good 6 months or 1 year. So in this case, I would also like to caution all you investors who are investing in China. This is not the first time that they have intensified crackdown and regulation requirements on companies, and it will not be the last time. Who knows, maybe in the next 3 to 5 years, it might be a round 2 or round 3. So for those of you who have been holding the bag and for those of you waiting for the recovery of all these different companies, I would suggest that you exit all your different equity positions in China if you are not comfortable and you do not buy into the long-term trajectory and long-term vision of the Chinese economy and the Chinese government. So this is just my 2 cents of investing in China. But specifically, as I promised at the start of the video, let's look back into the entire financial regulation and financial industry that has been evolving in the last 6 months. Now, let's take a deeper look into the entire industry and understand from the government's perspective why are they so interested in data monopoly and more importantly, the systemic risk that a lot of them like to talk about. So with that in mind, this is just a very quick crash course for those of you who actually forgotten about the dominance of Ant Financials and the entire system itself. Now, Ant Group and Tencent actually claim over a 90% share of China's mobile payment market, allowing them to collect a vast amount of consumer data. This could allow them to induce overspending, which may lead to loan defaults and coercive collection. The government is also worried about the poor track record of consumer privacy protection by tech companies. So if you were to look at the mobile payment market share in China in Q2 of 2020, Ant Group actually hold around 55% of the entire pie, while Tencent, which is WeChat Pay, holds around 38%. And in this case, if you were to really identify and observe the entire trend in terms of the micro-lending space, it's essentially an exponential increase, and it's quite crazy if you were to look at the rate of growth. Right now, I think the biggest concern is really the systemic risk that all these fintech companies really pose to the entire financial system. And they really cause a very huge strain and allowing all these different frivolous lending or allowing more consumers to take up a much higher risk and at the same time put on the pressure onto all these different banks out there. Now, the clampdown arose in part from China's increasing concern over systemic risk in the financial system, as the country's household debt to income ratio shot past the pre-crisis level in the US. Fintech's facilitation of large amounts of loans without bearing the associated risk has alarmed regulators who are also worried about the over-reliance on algorithm, lack of collaterals for such lending, as well as cybersecurity. So let's talk about the household debt to income ratio later. Let's look at how currently the online loan works. Essentially, there are 3 main parties in this entire equation. First, the borrowers, second, the fintech firms, and thirdly, which is the partner banks. So essentially, like all of you know, the fintech partners or the fintech firm, which is Ant Group in this case, really just help facilitate the entire transaction and their loan disbursement. So from the perspective of the borrowers, so let's say for example, they would like to take up a loan. All they have to do is to go into the fintech app, which in this case is Alipay, and they just have to fill in the necessary forms and go through the necessary checks. The fintech firm will have their own algorithm-based credit analysis, and they'll do their own analysis on the profile of the customer, and after that allow the borrower to recommend and match all these specific loans and different banks that have the ability and have the risk profile to take on all these different loans. So with these new regulations in place and this nationalizing of all these different credit rating system, so what the regulators are essentially trying to do is really to remove this entire fintech firm out of the equation. Essentially speaking, the borrowers will then have a straight line of communication to the bank in terms of taking up a credit line or just getting out a loan from these different banks. And by having them removed from this equation, all these banks will still have to get their information or their data from a certain specific entity, regardless whether is it from a private firm or from a government firm. So in this case, their attempt to try to nationalize and congregate and centralize a national credit rating agency is so for the banks to take reference or to achieve and to access all this different data of all these different individual consumers. Of course, if you were to look at the current fashion of how things are playing out, a lot of all these different risks bared by all these different banks is fundamentally reliant on the algorithm-based credit analysis. So could there be some screw-ups or could there be some issues or inherent problems with all these algorithms? Sure. Which is also why the funny thing is, a lot of all these banks rely on all these fintech algorithms. Yet at the same time, the fintech algorithms do not have to take on all these risks. Do you think there's a very big conflict of interest? And do you think there's a very big problem in this entire issue? I personally think that there's a very big problem, which is also why Ant really did a very good job in trying to exploit the entire system, which I would have to give credit to all those very bright minds working in Ant Group. But like I said, if you were to bet onto China, we want sustainable long-term growth. And in order for them to deliver long-term sustainable shareholder wealth, the entire economy and the fundamental bedrock of China's booming and prosperity should be predicated on sound fundamentals and not just a hit-and-run exploitation of the system. Next, if you were to move on to look at the household debt to income ratio, I think a very huge concern of the regulators or the government specifically is that if you were to look at in the US, if you remember the 2008 crisis, the entire debt to income ratio at the end of 2007 was around 133%. And just in 2020 alone, the current debt to income ratio in China is actually 139%. So this implies and translates to a higher debt to income ratio, and this is extremely alarming to different regulators, because does that hint or does that reflect a certain type of bubble in the making? And does it mean that a lot of people are currently over leveraged and spending too much over their means? I think there's a very big issue with this entire debt to income ratio. I think from the regulator's point of view, there really are only two mechanisms to help solve this issue. Number one is either you try to reduce the debt, bringing the numerator of the equation down, or number two, you try to increase the income by increasing the denominator of the equation and ultimately reducing the ratio as well. So if you were to really look at the current positions and posture the Chinese government is doing, they're essentially doing both. They're trying to first reduce the amount of debt taken up by all these different consumers by ensuring and by restricting all these different fintech companies, by reducing the outstanding debt disbursement, and on top of that, also trying to look into ways to protect a lot of all their consumers' income. And more importantly, this entire idea of common prosperity and strengthening and expanding the entire middle class. So as you can see, if you were to really look at the entire situation happening and playing out in China, they're really tinkering with a lot of all these different variables to ensure that they try to achieve long-term sustainable growth. And of course, in the short run, if we happen to invest in this kind of companies that has been exploiting the system in one way or another, they would be experiencing short-term pain. But in the long run, if you are investing and if you buy into my own investment thesis on investing in China, then I don't really see a very big issue. So with that, please leave in the comment section down below what do you think of this entire China regulatory crackdown, especially on Ant Group and especially on Alipay. And with the decoupling and divorce of the payment services app and the micro lending app. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!